Shiba Inu is being saved by insiders. Small investors lose everything and large wallets are smiling. That sentence sounds cruel, but familiar because you have seen this movie before, just with a different mascot. A cute logo, a loud community, and a promise that everyone can win together. It starts with excitement and ends with silence. And somewhere in the middle, ownership quietly changes hands. At the beginning, Shiba Inu was never about technology. It was about belonging. You were not buying a protocol, you were joining a crowd. A joke that became a movement. A meme that turned into money. It felt harmless, playful, democratic. Anyone could buy a little and feel early. That feeling is powerful. It pulls people in faster than white papers ever could. When price rises fast, it creates a shared illusion. You are not just making money. You are proving that the system is unfair in your favor for once. Screenshots spread. Stories multiply. And suddenly nobody wants to hear about risk. Because risk sounds like doubt. And doubt sounds like betrayal. This is where the trap begins to close. Meme tokens thrive on visibility. Visibility creates volume. Volume creates liquidity. Liquidity attracts larger players. And once large players arrive, the game changes even if the language stays friendly. Small investors see candles and think demand. Large wallets see order flow and think opportunity. When Shiba Inu surges, insiders do not celebrate. They prepare. They understand something retail rarely does. Price is not movement. Price is redistribution. Every spike is a negotiation between fear and patience, between urgency and capital, and urgency always loses. As excitement peaks, insiders do not rush to sell everything. That would crash the chart. Instead, they sell slowly, carefully, in waves, enough to take profit without killing the story. The meme must survive for the exit to be complete. This is why rallies feel exhausting. You buy dips that never recover fully. You hold through pumps that fade too quickly. You feel close, but never satisfied. That frustration is not accidental. It is structural. Liquidity is being drained without stopping the music. Small investors feel this as bad luck, wrong timing, emotional mistakes. They blame themselves. They tell each other to hold stronger, to believe harder, to wait for the next catalyst. Large wallets feel something else. Control. They can wait because they are not trapped by emotion. They entered early. Their cost basis is low. Even selling a fraction is profit. Volatility is not danger. It is a tool. This is the first uncomfortable contrast. Retail experiences time as pressure. Insiders experience time as leverage. When price drops, sharply panic spreads. Fear accelerates decisions. People sell to protect what little remains. This selling creates the exact liquidity insiders need to accumulate again at lower levels. And so the cycle continues. Pump attracts attention. Attention attracts retail. Retail provides liquidity. Insiders exit quietly. Price falls. Retail panics. Insiders buy back cheaper. The meme resets. From the outside, it looks like chaos. From the inside, it looks like a system that feeds on emotion. Shiba Inu did not invent this pattern. It perfected it. The branding matters. A dog is not threatening. Humor disarms skepticism. Criticism sounds joyless. Anyone raising concerns is accused of hating fun or missing out. This social pressure keeps people silent longer than logic would. And while the community argues about loyalty, ownership continues to concentrate. Large wallets grow larger. Small wallets disappear. This is the second uncomfortable contrast. The louder the community talks about decentralization, the more centralized the ownership becomes. On-chain data often shows this clearly. A shrinking number of wallets holding an expanding share of supply. But most people never look. And even when they do, they are told it does not matter. That whales always exist. That this time is different. It never is. When insiders step in to support price, it is called confidence. Strategic buying. Belief in the project. But support is not charity. It is positioning. They do not buy to save you. They buy to reset the cycle. This is where the phrase insiders are saving Shiba Inu becomes misleading. They are not saving it. They are stabilizing it enough to keep the game going. A dead meme cannot be monetized. So price is kept alive. Not healthy. Not growing sustainably. Just alive enough to attract hope again. For small investors, this feels like betrayal. They were told the community was united. That everyone wins together. That holding was strength. They discover too late that unity does not mean equality. Markets reward patience only if you can afford it. Insiders can. Retail usually cannot. Bills arrive. Emotions break. Time horizons shrink. This is why small investors lose everything slowly, not instantly. Loss comes from exhaustion, not a single bad trade. You hold through drops waiting for recovery that never quite reaches your entry. Each bounce tempts you to stay longer. Each dip makes leaving feel pointless. This is not accidental design. It is behavioral finance at work. Meme tokens are perfect pressure chambers. They compress hope and fear into tight cycles. They turn identity into risk. Selling feels like abandoning a tribe. Holding feels like loyalty. Insiders do not have tribes. They have strategies. When large wallets smile, it is not because they enjoy your pain. It is because the system works exactly as expected. Emotion provides liquidity. Liquidity provides exits. Exits provide capital. This is the third uncomfortable contrast. Retail looks for fairness. Markets look for flow. As long as Shiba Inu remains visible, this pattern can continue. Listings, news, rumors, burns, upgrades, partnerships. Each story renews attention without changing fundamentals. Each wave brings new participants unaware of the last cycle. Old holders become exit liquidity for older insiders. New holders become exit liquidity for current insiders. The latter never ends. It just shifts rungs. And the meme helps everyone pretend this is normal. Critics point this out and are ignored. Supporters accuse them of spreading fear. The community polices itself in defense of the dream. And the dream is profitable for those already positioned. This is why insider support is dangerous. It masks decay as recovery. It delays collapse while deepening imbalance. Eventually something breaks. Either attention fades, or liquidity dries up, or insiders decide the opportunity cost is no longer worth it. When that happens, there is no dramatic announcement. No warning. Price simply stops responding. Silence replaces noise. Small investors are left holding a story with no audience. They look around and realize the community they depended on has thinned. The insiders are gone. The smiles disappeared long before the collapse was obvious. By the time certainty arrives, there is nothing left to sell. Shiba Inu does not need to go to zero to destroy people. It only needs to go sideways long enough for hope to bleed out. That is the quiet cruelty of meme markets. They do not kill you with a crash. They drain you with time. So when you hear that insiders are saving Shiba Inu, ask a harder question. Saving it for whom? Because every time price is rescued, ownership shifts. Every rescue has a cost. And the cost is almost never paid by the people doing the rescuing. Small investors lose everything not because they are foolish, but because they are human. They trust stories. They fear missing out. They believe community equals protection. Large wallets smile because they understand one simple truth. In markets built on emotion, the most profitable position is being the one who never needs to feel it. And that is how Shiba Inu survives. Not as a fair opportunity, but as a machine that converts hope into exit liquidity until there is nothing left to convert.